Okay, let's dive right into this. Welcome back to another explainer. Today, we've got a seriously fascinating scenario, one that's really going to put your knowledge of income tax law to the ultimate test. Our main goal here is to crack a pretty complex CA intermediate client case study. We're going to see firsthand how different business structures, setup dates, and tax regimes can just collide, and create totally different financial outcomes for a taxpayer. So if you love seeing how textbook theory actually translates into real-world strategic advice, well, you are in the exact right place.
Now, I know. At first glance, this illustration 8 looks like a completely intimidating, dense wall of text just waiting to trip you up, right? It's got all these dates, massive rupee figures, different sections of the Income Tax Act, multiple businesses, all just mashed into one giant paragraph. But hey, don't let it overwhelm you. I promise, by the time we wrap up today, we are going to break this whole thing down into incredibly simple logical steps. You're going to see exactly how the mechanics work behind the scenes.
So, here's our game plan for today. First, we'll meet our client, Mr. Ashan. Then, we'll decode his two businesses, take a hard look at the normal tax regime, explore the default regime under 115 BAC, and finally, deliver our advisory verdict. We've got a solid structure to tackle this, so let's get moving.
Step 1. Meet your client, Mr. Ishan. Really, it's a tale of two very different businesses.
To solve this the right way, we really need to shift our mindset and step into the shoes of a tax advisor. Mr. Ashan has a pretty diversified setup. On one hand, we've got a washing machine production unit set up in a special economic zone back in the 2019-2020 financial year. And on the other hand, there's a much newer agricultural warehouse that became operational in 2025. These are two completely distinct business streams, which means we need entirely different tax strategies for each.
Which brings us to part 2, decoding those two businesses.
Because Ishan operates in completely different sectors, he triggers totally different rules and incentives under the Income Tax Act. Let's start with those washing machines. The case tells us straight up that his SCZ unit checks all the boxes for Section 10AA. And why do we care about that? Well, because Section 10AA is a massive tax deduction designed specifically to incentivize exports. But here's the catch. It's not just a flat deduction. The actual benefit you get relies heavily on the ratio of your export turnover compared to your total turnover. And that is exactly why they give us the specific export and domestic sales numbers for this unit.
Okay, now let's pivot to the newer business. His agricultural warehouse fulfills all the conditions under Section 35 AD. Guys, this section is a real game changer. It allows for a 100% deduction on capital expenditure, as long as it's incurred wholly and exclusively for specified businesses in the year they start up. But there is a huge trap you have to watch out for. It strictly excludes the cost of land. So for the warehouse, managing this capital expenditure math is absolutely key to unlocking those major deductions.
All right, part 3, the normal tax regime. Let's run the numbers through the standard provisions.
So how exactly do we calculate all of this? Let's just lay out the roadmap real quick. Step 1, we take his raw business profit. Step 2, we apply those powerful Section 10A and 3580 deductions we literally just talked about. And Step 3, we compute the final tax. But, and this is crucial, we have to check it against the AMT, the alternate minimum tax. If you just stick to these 3 steps, you will never get lost in the weeds.
Now what's really interesting here is how these numbers interact for the SCZ unit. His profit sits at 40 lakh rupees, his export turnover is 80 lakhs, and domestic sales are 20 lakhs, which gives us a nice clean total turnover of 1 crore rupees. Now under Section 10AA, we don't just magically deduct the entire 40 lakhs of profit. No way. We have to use those specific turnover figures to find the exact proportion of profit that's eligible for the exemption. Since exports make up exactly 80% of his total turnover, that 80% dictates the actual deduction he gets to claim. It's a simple ratio, really.
Let's apply that exact same logic to the warehouse facility. He's got a very healthy pre-deduction profit of 1 crore 5 lakh rupees. And the case states his total capital expenditure was 75 lakhs. But wait, remember our golden rule for Section 35 AD? Land is excluded. The source explicitly notes that this 75 lakh figure actually includes a land cost of 10 lakh rupees. So we have to methodically subtract that 10 lakhs to find that his actual eligible capitalization for the 35 AD deduction is 65 lakh rupees. And it's this 65 lakhs that we use to offset his massive warehouse profits.
But hold on a second. Under the normal provisions, you can't just claim these massive deductions like 10AA and 35 AD and then just walk away paying 0 tax. Don't forget the AMT, the alternate minimum tax under Section 115JC, is kind of like the hidden trapdoor of the normal regime. Whenever you claim these heavy-hitting deductions, the government steps in and says, hey, recalculate your income and make sure you're paying at least a minimum baseline of tax. For assessment year 2026-27, computing this 115JC liability is literally an absolute must.
Moving on to Part 4, the default regime under Section 115 BAC. Let's see how this builds.
Okay, so under the 115 BAC default regime, we see a really dramatic shift in the rules. If Mr. Ishan decides to go down this path for AIY 2026-27, basically everything we just calculated gets completely wiped off the board. Under 115 BAC, you generally have to give up those special exemptions to access a different set of tax slab rates. That means the Section 10 AA deduction for the washing machines, gone. The massive 35 AD capital deduction for the warehouse, also gone. Instead, he'd just be claiming standard normal depreciation on the warehouse building. But, and here's the trade-off, in return for giving up those deductions, those pesky 115JC AMT provisions, they don't apply to him at all anymore. It just fundamentally alters his entire taxable income base.
And finally, Part 5, the final advisory verdict.
So the crucial point here is comparing the two outcomes. As his tax advisors, our entire job is to calculate the total tax payable under the normal provisions, including that tricky AMT trap, and stack it up against the tax calculated under the 115 BAC default regime. Basically, whichever calculation results in the lower tax outflow for Mr. Ishan based on his specific data, well, that's the path we have to recommend.
The original case study left us with this exact mandate. Advise Mr. Ishan whether he should pay tax under default tax regime or normal provisions of the Act. By meticulously applying the 10 AA rules for his exports, carefully backing out the land costs for 35 AD, and then weighing the AMT burden against the 115 BAC framework, we built the exact blueprint needed to give a mathematically backed recommendation that truly optimizes his wealth.
Before we wrap up, I want to leave you with this to ponder. How would our entire final advice have changed if that 10 lakh rupees spent on land was instead poured directly into upgrading the warehouse structure? Just think about how that single, tiny variable would alter the 3580 deduction, which then cascades right into the AMT calculation and potentially flips our entire regime recommendation upside down. It just goes to show you how incredibly sensitive tax planning is to every single financial decision. Thank you so much for joining me for this explainer. Keep asking those great questions, and I will see you next time.